Good morning and welcome to the Monday Call, brought to you by NZ Funds. I'm Stephan Clark, Chief Client Officer at the firm, and in the studio this morning we have Mark Brooks, Chief Investment Officer, and James Grigor, Investment Strategists. It has been a year of headlines. Conflict in the Middle East, higher oil prices, and geopolitical uncertainty have tested investors. Yet the global economy remains remarkably resilient. Beneath the surface, growth is holding up. The global share market has moved higher and new opportunities are emerging. The investment landscape is also broadening. AI and US technology remain powerful themes, but opportunities are appearing elsewhere in cyclical sectors and in markets beyond the United States. New Zealand is among them, with improving economic indicators, rising confidence, and early signs of renewed momentum. Exciting backdrop. Mark, James, it's great to have you on the studio. Welcome.
Good morning.
I thought we could start with a really big, high-level question, which is, where in the cycle are we today? And when we think about this, how should clients understand this in relation to their portfolio and our outlook?
Cool. I'll probably take that one, Stephan. Also, morning, everyone. Look, I think, as you touched on, given the headlines, you would expect that the world's a pretty challenged place. There is, conflict, there's new tariffs, there's inflation in places, potentially an AI bubble, lots of noise and disruption going on. But actually and especially from an economic perspective and ultimately how it relates to sort of clients, the outlook is actually pretty strong. I think if I sort of deal with the sort of, the building blocks of the growth portfolios for clients, it really is, there are three building blocks. There's New Zealand, Australian shares, there's global shares, and then there's sort of the macro tilts, things like commodities, etc. And if, the bulk of the assets or the bulk of, the key drivers will really be those first two parts, New Zealand, Australian shares and global shares. And if I sort of think about each one, New Zealand, very much, a muted situation, but given what's happened, actually, and we've had some interest rate rises from and an interest rate rise from the Reserve Bank, we've had higher oil prices and headline inflation's quite high. Despite that, actually, we're starting to see almost, in spite of it, growth coming through. And you're seeing that, especially in some of the surveys, very strong suggestions out of the manufacturing PMI, which has historically been a good lead indicator for economic growth, that's well into expansion territory. So that's quite positive. You flip to somewhere like the US or even sort of globally, the global economy entered this year in a relatively strong position, sort of slightly above trend growth. And actually, because what's happening in things like sort of AI and other aspects, areas like Asia are very strong because of chip demand and other things like that. And then you move to somewhere like the US, and actually, there were concerns about a K-shaped economy where the top tier was doing well and the bottom tier was doing poorly. Reports out of the major banks recently in their Q2 numbers were really, really positive and sort of saying that actually growth is getting stronger, it's broadening. You're seeing really strong interest in things like M&A, but actually even delinquencies across the spectrum are falling, not rising. So all of that sort of signals an economy that continues actually to grow and get stronger. So again, the foundations out there are actually pretty strong.
As a Kiwi, it feels, at least it has done for the last few years, felt quite different. How do you juxtapose or compare New Zealand to that, and where are we at in terms of the cycle?
Look, I think, again, as we sort of often come back and remind ourselves and look to remind clients as well, it is that idea of a cycle. And we've talked many times about sort of the famous Sir John Templeton quote about how sort of positive markets, bull markets start, which is when people are really pessimistic and don't want to talk about it. That next stage is that sort of skepticism phase where they go, yes, it's up, but there's a war or there's oil. The third one is really the optimism, when everybody's behind it. And the last one is when it gets euphoric and just gets a bit silly. I think very much in the US and some other markets, you're very optimistic people. Or people are very optimistic. So it is towards the latter end of that optimism stage. So there's definitely a lot of expectation baked in. In New Zealand, the compare and contrast is we just haven't had the returns. New Zealand share market this year, depending which index you use, is somewhere between -1 and 1. So call it 0. From that point of view, if we go back over the last 5 years, your annualized return out of New Zealand has been 0.9%. That says two things to me. One, that you get a mean reversion of markets over time. Shares, regardless of where you own them, over very long periods of time, do 10%. We had a strong period for New Zealand in the sort of 2010s where the New Zealand share market was that rockstar economy and continued to deliver really 15% type returns. We've had 5 to almost 6 years now of broadly nothing. It's really well primed. Expectations are very, very low. So we actually think New Zealand is well placed, although it's been difficult. To your point, that sort of juxtaposition, clients are sort of saying, well, why don't you own more international? We're saying, well, international or global shares are great. We want to have a big portion of that, but equally, New Zealand, expectations are low. And when expectations are low, it doesn't take a lot in terms of positive news, positive revenue, positive earnings to actually wake up a share market.
It's interesting that New Zealand example, as well as when you think about it from we always talk in the macros, interest rates, growth of the economy, etc. Sometimes when you take a step back and look at the underlying shares of that market, you really get a sense of where the value is. So one that comes to mind immediately as Mark was talking is the retirement village sector. Look, that's been a tough sector to be invested in. But when you look at how you think about valuation of that sector, the shares trade on a multiple of net asset value. So I always use the example of someone's walking around with a clipboard and is valuing, as we get our houses valued by some external party, a value of all their retirement villages around New Zealand. And then the shares trade on a multiple of that valuation. And when the economy was stronger and house prices were not decreasing, maybe they were actually slightly increasing, then those companies would trade on many multiples of net asset value. In fact, they got up to sort of almost silly levels, sort of 8 times net asset value. But I think on average it's been somewhere around, don't quote me on this, but 2 to 3 times net asset value. Yep. They're currently trading at about 50% of net asset value. So, and let's pretend that net asset value, so the valuer, that the external valuation of these retirement villages, that let's say they're too optimistic, even though they're independent, too optimistic. So let's say that they should be actually valued at 70% of what they're valued at now. Well, you're still buying them for a 20% discount. So there really is a huge amount of value sitting in the New Zealand share market. That's just one sector that comes to mind when we think about it. And it shows when we start to see a change in earnings through changes in things like GDP growth and things, but also just a change in mindset around actually mean reversion is coming, as Mark talked about. We'll really see some good increases in share prices to reflect actually 50% of net asset value is too cheap for that sector. And it goes across a number of different sectors as well. So I always like to go and use really specific stock-specific examples, not just, hey, it's been really bad recently and it'll get better. That is definitely the case. But when you look at the actual stocks on the ground, things are really cheap.
Yeah,
I know the other one, and this is Mark's territory in terms of him and I know he'll agree with me because we talk about it a lot, so I'll say it anyway. But when we think about these gentailers, and there's some news on the radio this morning on national radio talking about these gentailers will build more capacity for data centers. Think what you like around that. That is really good news for those companies and the earnings of those companies to have long-term take-or-pay contracts on electricity generation for data centers. These things are cheap.
Yep.
and those companies have actually done quite well compared to other parts of the New Zealand market. So, there's reason to be positive.
Yeah, well, again, I think that issue of valuation and it becomes, I suppose, something we used to, but certainly clients may not be. But we do think in the terms of, what multiple of earnings are we paying for businesses? And if I look at sort of the NZSE 50, yeah, earnings have been depressed, right? And haven't gone anywhere for a long time. And even given that, we're actually seeing the share market on average is sitting at about 12 and a half times earnings. So the share market valuation is about 12 and a half times what earnings are. That is bang on the average. Given actually earnings are depressed, there's no positivity being priced in there. Often you would expect that actually things would look a bit expensive because they were sort of forward looking and starting to build in future growth, but that's not. There is that sort of skepticism still out there. So we really do think there's, it's been a long wait. You've got to be patient, and there are times when you go, well, how patient do you want to be? But it's worth holding New Zealand shares. We think is a decent part of the portfolio.
Why has the global economy been so resilient? And why has New Zealand had such a tough time during that period? And Australia might itself be entering a tough time too, I hear.
Shall I take that? Yep.
All yours.
Look, I think
It's easier to go second. So
yeah. Look, I think in many respects, to a degree, it's been. This might sound slightly odd, but inflation has been slightly beneficial in the sense if you think about companies, and we're very much focused on what share markets are doing and what companies do. The economics profession talks in real growth, and that's correct, but it doesn't include that inflation component. Whereas a company will earn nominal dollars; they don't sell real dollars; they sell nominal dollars. So actually, if we look at places like the US, their real growth is actually not too bad, sort of mid twos, high twos, certainly at trend. And I'll touch on why I think that's the case. But if we go back to the nominal number, with inflation, that number's getting closer to 6%. So actually, there's quite a lot of activity. A 6% nominal GDP growth basically says that economy is going to double every 12 years or so. So none of that's bad. If we think about what drives economic activity, there's really three things: consumer, government, and investment. And consumer globally has been okay. Governments generally have been spending a lot. That is probably an issue further down the track, but here and now it's still spending. And certainly in the US, one of the reasons probably the US has come through this process so well is actually because of that sort of one big beautiful bill last year, decent amount of tax cuts at the start of the year. So you had that come at a time when you had that higher oil price, right, higher petrol prices. So that was a nice counter. So you've definitely had government spending. And the last one, and you see a lot of talk about it, but the AI spending is massive. It's real, and it's quite broad in terms of its impact on things like, chip consumption, computer consumption, electricity, all the services, etc. So, and in many respects, potentially what we're seeing for the first time in many, many years is a real capex boom that's actually creating real demand for capital.
It sort of seems to me also that the housing market has a big influence, and it's not to say that the US housing market is running away and doing really well, and ours isn't. In fact, the US housing market isn't going overly well, and they've got sort of similar issues. It depends, and it's a huge country. It depends the state and the city and those sorts of things. So it's a really general statement. But when the housing market doesn't do well in New Zealand, and you're sort of alluding to this in Australia, is starting to perhaps, you're a brave person to call the top of the Aussie housing market, but starting to creak, it has a pretty direct effect on velocity of money. What do we call it? N2. And if there's less buying and selling of houses because people are not willing to make that sort of transaction, then there's this less momentum in the velocity of money, and that generally slows things down. And there's that perception of feeling poorer.
Wealth effect.
Yeah.
Yeah.
And so when you're thinking about, should I do an extension, which is good for Fletcher Building, or should I go on an overseas trip, which is good for Air New Zealand, and all those things that make up the New Zealand share market, when housing is, unless you live in God's part of the country, which is Central Otago, or Christchurch
Southland,
and Southland, but then make your way back up to Wellington or Auckland, and you're starting to still see maybe stability, but that wealth effect is real, I think, and that does slow things down in terms of people's mindset and positivity around wanting to.
Yeah, I think that wealth effect is real, and people's desire to go, actually, to use that sort of cricketing analogy, get on the front foot and play offense is definitely not there. Gets on to a topic we've probably raised a few times, that definitely, my view would be that Reserve Bank's desire to sort of get their OCR up from sort of 2.25 to 2.5 and head back towards that 3%. My research suggests, actually, because of the wealth effect, that drag actually suggests your neutral is not 3. It's actually probably closer to 2.5 that we're at now. So I don't think there's that need. But yeah, that's one reason. It's probably a key reason, I think, you touch on, that New Zealand has. If you think about those aspects, the government hasn't really been spending to the same degree, and the consumer, in many respects, has really been held back by that wealth effect and the lack of not incentive, but just not feeling positive enough to go and spend.
And it feels like there's a structural change in housing somewhat in New Zealand, where it very much was a generator of wealth in terms of a family. So you have your house, and that creates wealth because you have leverage effectively, but also you can then use that leverage to buy investment property. But that seems to have stopped for a couple of reasons. One, the people that have those sort of cash deposits ready to then buy those investment properties are perhaps at the stage of their life where they don't want to have a property that they manage and tenants and maintenance and all those sorts of things. And so there's less demand for that, which is good for first home buyers, because first home buyers are sort of stepping up and becoming a key part of that market. And that really means that sort of recovery, because there's value in the New Zealand housing market, is slower, because you don't have that pent up demand of people wanting to jump in and buy these properties, which overall, I would say this, wouldn't I? But overall, that's a good thing for the economy, because it means that it broadens it to it's an economy not just made up of house prices, it's an economy made up of many things. But that transition takes a while. We've had 40 years, 50 years of amazing growth in the New Zealand economy, really, really driven by house prices. And we're transitioning away from that, and small businesses and large businesses, but also other aspects of the economy are the important drivers. But that takes more than a couple of years, and if it only takes 5 or 6, then that's probably a pretty good outcome.
It's a huge achievement. Yeah.
And it's not just been one government, it's been many governments on both sides. It's been someone quoted in I forget what podcast I was listening to as I was running, but it's an amazing achievement that successive governments on both sides of the aisle have both continued to essentially put in policies that have put a stop to the housing market increase, which is politically a really challenging thing to do, and yet it's been quite, and I don't know if that's accidental or not, but it's been quite an agreed strategy that for the need to do it, and that's been happening.
It's also been incremental. You have, one policy and then another policy and then another policy, and bit by bit, they're turning it. Okay. What do you make of the oil price today and its impact on the global economy and in turn the New Zealand economy? When you think about the spectrum of risks that apply to us and our clients, how should we interpret that? I know you both trying to answer it, right? Like,
no, yeah. This is probably the question, really, isn't it?
Look, I think probably the main impact, I think, in the short term or in the medium term is actually more about perception and perceived risk rather than actually impact. I think, clearly we got through that first round. Yes, petrol price went up, etc. But the world economy's found ways to reroute a lot of oil. And, as always and oft, well, not always, but, again, it's shown itself as being really resilient. And, there's that inflation shock. Does that become embedded? Only time will tell. But go places like the US, they've had sort of, on the flip side, they've had these tariffs rolling off. We had the big impact of tariffs last year, which was an inflationary shock for the US, but like a GST imposition. That's kind of fading. We've had a little bit of oil coming the other way, but in that sense, a little more balanced. So in some ways, I would sort of say it's risen, or it's created a higher level of perceived risk, and that's one reason I think why probably under the surface we've actually seen in things like share markets quite a big rotation happening in terms of different sectors, but also despite the headlines and despite sort of probably the move up since that initial sort of ceasefire, actually what we've seen is global markets generally trend sideways since about early June, so for the last sort of 8 weeks. And actually underneath that, valuations, coming back to that multiple idea, have really derated quite a lot. And I think that's probably the key part, or the key takeaway I'd want clients to sort of think about is, there's a lot of headlines about share markets being expensive. Actually, they're not. And I think part of it is down to things like oil and concerns around just risk. So people have been a bit more circumspect, and actually you've seen valuations actually in many markets move back towards average or even sometimes below average. You've got different comments, James, on that?
No, I think
it's not really answering the oil question in some ways.
I think oil price for the consumer or for the economy has less effect than it did perhaps 30 years ago. And that's for obvious reasons around just consumption in terms of more efficiency, in terms of usage, but also things like electric cars. I've been traveling recently. It is amazing the uptake of electric cars outside New Zealand. And you're noticing it in New Zealand too. I think I must have talked on this podcast about 18 months ago when I first got back to New Zealand. And one of the things that frustrated me is I bought an electric car and sold it 18 months later for about 20% of what I bought it for. That doesn't exist anymore. There's a real value in that electric car market, which is a tiny example of perhaps why it has less effect on the economy from a consumption point of view. But sure, I think the biggest thing is it does affect inflation. Initially, our view, which I think we were correct in having, was that these price shocks don't feed through into inflation. They're short term. There's a difference between headline inflation and long-term inflation, and the central banks genuinely look at long-term inflation. And the RBNZ, yes, it did raise rates, and the Fed was a bit more hawkish, but that was probably not in spite of the oil price, not because of the oil price. But I think the longer it goes on for, there gets to a point where you have central banks going, look, this is just getting a little bit annoying. That's a little bit annoying on inflation, and we perhaps have to think about dealing with it. But it doesn't feel like it's going to be I get the sense that there's a worry out there in the great wide world that we are going to have that inflation effect like we had during COVID. And the central banks got it wrong then. We were banging the table. They needed to raise rates, and they were way too slow. And then when they finally did it, they were way too fast because they and held it for too long at a higher rate. It doesn't feel like we're getting there. What it seems to me is that the RBNZ is in New Zealand is just trying to get back, like you're saying, to a more neutral rate, which is a good thing. It's good so that there's not a allocation of capital out there that's sort of irresponsible. And in the US, it's a growing economy.
Yeah.
And it's going really well. And and you need to make sure that you temper that. And the oil prices create this overlay of an effect. But oil's back at 100, and what did the share market do last week? It was about flat.
Yeah.
Um,
And I think this may wander into territory that gets a bit technical, but looking at especially US interest rates, they have moved higher. The 10-year is 4.70, so close to 5%, so as high as it's been really for the last couple of years. So is the shorter term 2-year rates. And the initial reaction would be to say, well, actually that's building in inflation concerns, but actually sort of forward-looking inflation prices in the market have been falling. And ultimately what that seems to be saying is actually because of things like AI, probably because of things like government borrowing, the demand from a robust economy is the demand for capital is really strong, and actually the price of money is going up because that demand for capital is high. That has some pretty important implications. It's generally pretty positive for share markets. Certainly positive for some commodities. I'm sure we'll talk about that. But it's not really a reflection of inflation concerns. It's more about that idea of actually there are a whole lot of good things to invest in, so I need money to do that.
And you don't want it too cheap, the money, because otherwise you're going to have companies that perhaps don't have a business case that's as strong as others getting an allocation of capital where they shouldn't be, and that makes for that's what creates things like a bubble. And actually you want the allocation of capital to be efficient and accessible enough that companies and economies can grow, but not too easy that it makes companies that don't have a good proposition for investors enable them to get capital. You don't want those companies to get capital until they're ready for it.
Yeah. When you talk about valuation earlier and perhaps being below average, and then I guess it plays into the capital allocation piece as well. And then at the same time, there's this idea of AI companies or technology companies and there being a bubble. How do you, is it simply that there's one sector or one bucket, for a better word, of companies that are trading at multiples that make them look cheap, and another bucket where they are far from that? Or is it more complicated than that?
I think in many respects there are small pockets where some of the valuations for AI names, by definition of what's happening, are pretty punchy and aggressive. But in many respects, what we've seen really over the last almost 1 year is actually a share market that's been pretty disciplined and effectively has said, well, you're spending a lot on these AI products or the infrastructure that is hard. They're hard assets, hard capital. There's a lot of capital required. You're not a low capital light software business. So actually we're going to probably temper our enthusiasm in terms of valuations. And, for that reason, despite I think it's one of the big differences with the headlines is, people have seen global share markets move higher, certainly versus, probably the beginning of the year or sort of even back further. But in many respects, certainly more recently, we've seen markets go sideways. But at the same time, we've had really strong earnings growth. And what that has meant is actually valuations, rather than being stretched, are far from it. If I look at something like the broad S&P, that's on, looking at sort of multiple of EBITDA, 13.5, 13.7 times. That's bang on average over the last 5 years. Go back to October, that number was closer to 16 times. So that's quite a material derating. If I go to somewhere like the NASDAQ, very much the same. NASDAQ is on 15 times, actually below average. Average over the last 5 years has been about 16 times, and it's been up near 19. So in many respects, the market has been, and it continues to be, very almost circumspect. And that's probably the clear argument for us is as we look forward with things like the midterm elections, et cetera, and the typical pattern there where you get a form of political gridlock, that actually one reason why we're actually really positive on markets going forward is actually we have seen this derating in valuations. Earnings growth remains strong. So, and part of that is really that sort of movement under the surface, as you touch on. So, and probably a broadening of activity. More recently, and it's probably it's been over the last couple of months, but you've actually seen areas like, say, the S&P equal weighted index versus the standard one. So the standard one is dominated, basically companies come in based on their size, whereas equal weight is, as the name suggests, all 500 companies have an equal weight. The equal weight tends to be more value orientated, less technology heavy. That's actually outperformed, which says you're getting a broadening of activity and in some respects a broadening of AI uptake, AI use across probably some pretty boring industries like technology, transport or utilities or things like that.
And it's again looking at the micro, and this is a bad example perhaps because this company's not listed, but I guess a way of describing what's happening there with that multiple is the earnings are coming.
Yeah,
These companies are making
share
earnings.
prices are not going up, but earnings are coming through.
And if you look at Anthropic, so for those of you that use AI, Anthropic owns Claude, and that's one of the key sort of consumer and business AI models out there. So 4 years ago, they were making zero revenue. Now they make, and then about, I think, and forgive me if these numbers are not quite accurate, I'm trying to find it in that space in my head somewhere, but about 2 years ago, they had a revenue of about 3 billion.
Yep.
This year they have a run rate revenue, so by the end of the year they will have a yearly revenue of about 30 billion. So they've gone from 0 to 30 billion in revenue over the last 2 or 3 years, and their margins are not reported, but they're probably upwards of 60-70%. And so, this is a huge amount of not just revenue growth, but earnings growth for a company that was not doing anything 3 or 4 years ago. In fact, people were calling that Anthropic was probably didn't quite have the right strategy and weren't going to do very well.
Yeah.
And that's the actual AI companies. But then, as Mark points out, it's the productivity gains and the revenue and earnings revisions because of usage of AI, which is sort of the part that we're excited about.
Yeah.
And you're seeing it in those earnings coming up, so multiples coming down.
Yeah, again, I think there was a stat last year that this time last year, and this is probably Q1 numbers, so we're US companies are sort of going through their Q2 numbers now, but in 25, 14% of S&P companies reported actually having something usable in AI. Now that number's north of sort of 27, 30%. So it's rapidly increased. And yeah.
I always, I can't help but every time I hear someone calling that there's a bubble somewhere or that something's completely overvalued, thinking about businesses like Facebook and Uber, which came to market with no profit at all. So, infinite multiples effectively. And there was, an infinite number of naysayers as well at the time. And now both of them are in their own way incredibly juggernauts. There was a period post-COVID when Facebook was just apps, and I hadn't looked at their numbers recently, but at the time it was just printing insane amounts of cash, and the earnings were phenomenal. I'm sure it hasn't changed that much, and so I guess it's that ability to look, as you pointed to, look forward to the earnings and that they're coming, and if you believe that Anthropic's growth trajectory can be sustained, and as it has for many of these companies, and there's a lot more they can do, then what the multiples you're willing to pay a high price for that. So is it a bubble if you do it on if it's 100 times or 200 times or 5 times? It really depends on what time horizon you're looking at.
It also really reflects why active management's so important in this market, because of course there's bubbles within any sector.
Absolutely.
There's even bubbles in really boring sectors of just companies that have lost their way and they're overvalued, and that valuation needs to come down. And so being able to, I guess, be holistic and looking across the market and seeing where the valuation is and making sure we're in the right sectors and the right companies within these sectors is really important. And it's probably what we do a fair amount of research and talking about, that the market does move as a one big beast on the short term, but over the long term, the companies that are the best positioned and are showing form, like Nvidia has quarter in, quarter out. But there'll come a time perhaps when that's too expensive, but maybe not. But that's why we research. And so when you get commentary out there saying, you shouldn't be invested in unknown sectors like the space sector because, space is too expensive, or on what metric and what's too expensive, and at what level should you buy it at and what level should you sell it at? And those are all important questions where you can generate value within a construct that, there are going to be winners and losers. That's how the market works.
How do you think about them broadening beyond the States? A lot of our conversations orientate towards New Zealand and America.
Yep.
Obviously the markets we're most invested in. How do other parts of the world look? Europe, China, obviously we touched on Australia. And how does that flow currently into portfolio positioning?
Yeah, probably Australia to start with. Australia is probably going through a little bit of a challenging phase. It has been the lucky country, clearly. But if we think about that sort of activity level, demand in Australia has been very strong at pretty much all levels. House prices have been strong. Government spending's been really strong. And, they do have, maybe it's moderating a bit now, but they do have an inflation problem. So in that sense, the RBA is out of sync with others and is sort of more proactively had its foot on the brake. And, that probably suggests that Australia is kind of treading water at the present and probably may do that for some time. Other parts of the world, really have, I suppose, have benefited from different things. And Asia definitely has benefited from AI, the CapEx spend. One of the probably, often these things don't happen or don't happen alone. You get multiple of factors, and you look at somewhere like Japan. Japan has been a really strong performer this year. Why? Certainly it's been AI, and they have a lot of some of the heavy tooling, heavy technology, sort of oxymoron, I suppose, but these sort of heavy industrial businesses that can create some of these chips and etc. But equally, you have an economy that is and a share market that's continued to sort of move out of a 30-year downtrend.
Is this really cheap?
Yeah.
They've got a catalyst, isn't it?
Yeah, well, again, looking at these valuation numbers, you look at something like the Topics, which is our preferred index for versus the Nikkei. It looks expensive relative to the last 5 years. It's at 8.5 times, way cheaper than New Zealand or the other markets, much more expensive than 6 times it used to be on, but that's because companies are growing. You've actually got growth. You've got banks making money for the first time in 20 years. So, again, that's So generally, I think and it would be one of the themes is as we go further through this AI process, I think actually technology, for want of a better word, broadening away from technology companies actually being used across a really wide range of industries. And in that sense, you move outside of America, generally those other markets are cheaper. So if those other businesses are doing well, you're getting more bang for your buck outside of the US. And that would be the comment that we get back from Fisher International, our main external manager, is that they really like America, but they equally think that if you look at expectations and valuations, again, back to that idea of optimism versus something skepticism, they look elsewhere in the world and they see expectations that are much more muted, much lower and easier to beat, whereas the US optimism is pretty high generally, and that sets a higher hurdle for people to be positively surprised.
Within the portfolios that NZ Funds manages for clients, we have alternatives within our what we call our global macro portfolio, and that's one of the 3 building blocks you mentioned earlier. How does this the valuation piece, the oil piece, and I guess the general broadening of investment, and I guess the AI theme as well, play into the commodities and other alternatives held within that portfolio, and how do they act as for diversification purposes? You want to take that one, James?
Sure. Mike alluded to the buckets, or we also, as the children's blocks, the ABC of makeup of the growth portfolios, and I think that's the best way to describe what we're trying to do when we think about alternatives, and in this specific case, commodities. So the growth portfolios, just as repeating, but it's good to repeat an important point. New Zealand shares, we've talked about that. I think we know the investment case of why we're there. Plus, I'd add, I think we might have touched on it, but we should. It's also very tax efficient.
Yep.
The global shares is a key driver of wealth for people invested in growth portfolios. That is where the action is at the moment, but it's important to be diversified around that growth. It's not just a US play, as Mark was talking about. I'm looking over Mark's shoulder at some of those Japan numbers. It is amazing. I didn't quite appreciate how cheap it got from a multiple basis. The third block, though, is also very important for two reasons. One, it is a different and diversified way of generating returns within an economy. But also importantly, it's not correlated to those first two buckets. And that is a key reason why we think it's important to have an alternative type of block within the growth portfolios. And when you then take that a step further, in fact, some of the volatility that comes with share markets can be caused by big increases in valuations of things like commodities. And so when we have an inflation spike, often that comes and is driven by increases in commodity prices. What we're seeing now in oil, often we forget that oil is a commodity, and oil prices are going up. That creates inflation. That creates the expectation of interest rates going up. And at the main, share markets don't like that and tend to trade sideways or down. But if you can also be invested within that asset class, and so you're starting to see as a portfolio manager, and when you allocate capital as a client to a growth portfolio that has these three, you're starting to see that you can get a much more longer term stable return when you include something like commodities, because often they can perform quite nicely when share markets are not doing much, when they're treading water or even trading down. So that's one aspect of it. We've done a lot of work around how we incorporate these assets into the portfolios. And what we really don't want to do is instead of. So we don't want to have a position within commodities instead of shares. We love shares. Shares are a magical.
They're going to be the bedrock of the portfolio.
And who are we to reduce exposure to shares for a long-term investor in a growth portfolio, which is 10 plus years? That would suggest if you want to be in a growth portfolio. So the way that we think about it is these are an overlay or an addition to the shares in the portfolio, and we can do that using futures contracts, which means that's a fancy way of saying we can buy these commodities without having to sell any shares. So our exposure is the shares stays stable at, let's say, 100% invested, and then we have some positions within, say, commodities that are over and above that. So our total positioning is more than 100%. And why we think that's really important is you still have the wealth generation capacity of shares, but you also have this alternative driver of returns that are uncorrelated to the share price. Then you can delve into the different views and assets that we own within this space, and they're varied, and we don't have to talk about all of them. But a great example is copper. So in the growth portfolios, if we have about a 10% position in copper. The demand for copper is astronomical. driven by two things: one, AI, and the amount of copper that is needed to, I guess, generate energy consumption in order to power AI, whether that's in data centers and the like. But also you have this other aspect of the economy around electrification and green energy, which is something that you don't hear much these days, given sort of the change in political views around it, in the sense that it's not highly charged as politically as it perhaps used to be. But the policies hasn't really been pulled to the extent that people perhaps thought they would. There are still policies around electrification, cars, the fleets, and then you're also getting the fact that electrification is just cheaper, so it's easier for the consumer. I don't think it's necessarily cheaper energy, but it's a diversification of the energy stack, and that just means that you need more copper. And so the demand for copper is going to increase 4 or 5 times. And the problem, or the reason why that is good for the price if you own it, or is that the supply for copper is very, very hard to react to that increase in demand. So I think it takes something like 10 years to from let's open a mine to actually getting copper production. And that comes from, you know, various things. It's in usually mines are in difficult countries to work in. There's regulatory effects. Then there's actually the creation of the mine and getting the commodity out of the ground. And those aspects mean that if you remember back to, if you did economics and school certificate or NCEA level 1, for those of you that are a bit younger, it's that simple demand and supply. If demand goes up and supply can't catch up, the price goes up. And that is a type of asset that we want to hold. It is not a 1 or 2 year view. It is a 5-10 year view, and we think that no matter what politicians do, no matter what the short term economy does, what interest rates do, that demand for copper will not decrease. And in fact, we think because of technology changes, it will do the opposite. It will increase. And so having that within a portfolio is, you know, can you afford not to have an asset class like that in a portfolio? And I'd go even further and say that there are institutions out there, especially global institutions, but we have one here in the super fund, but university endowments, the big famous ones, Harvard and Stanford endowment funds. You've got big pension funds, and also very high net worth family offices, all invested in these types of asset classes for a very, very long term reason. And we think that that there should be an ability for our clients to have that access to, and that's what we've done. Now, we could then talk about all these other commodities that we have, in lots of different themes, and the commodities stack will change over time. But overall, we think that's an important aspect of the portfolio makeup.
Yeah, such a clear explanation, James.
I think the one thing I would just add to that, and again, it is a question clients are asking, is if we think about sort of performance this year, you know, we're very strong views around commodities and their longer term demand. This year, that part of the portfolio, not necessarily copper, but other parts, have detracted from returns. So if we look at sort of, you know, clients might sort of say, well, global share markets have been higher. Why is that not happening in the portfolio? Well, yeah, if we think about it, it's those 3 building blocks. New Zealand has been basically flat. So, and certainly we've been positioned more, as we've talked in the past, more for that cyclical upswing. So some of the names which we did have, we certainly probably came back a bit more through the oil impact. So that's been a drag. The global shares part of the portfolio has done well, just like global shares, but also the macro tilt side has dragged a bit. So there's been some yin and yangs this year, I think, so far. Probably the point would be that, yeah, we saw that last year. It's not unusual. We are an active manager. Don't always follow exactly where the market is, and especially with things like commodities. It will give you that diversified return. Sometimes in the short term, that diversification will hamper.
Yeah, but it's the long-term thing, right? We're investing for the long run. That's one of the, when I was hearing you explain all of that, James, one of the things that stood out to me is just back to copper for a moment, is it's electrification as a theme is huge, and you've got countries like India and China still industrializing and building out cities and people migrating in and developing, and so if you can't access that other than investing through a copper miner, BHP, I don't even know if they still do copper, they probably do. Rio. So, there's, how else are you going to get exposure to these gigantic themes that are going on?
Well, we could absolutely get those themes through shares. The one aspect of different sectors have different, in terms of the share market, have different, I guess, knowns and unknowns. We know the New Zealand sectors pretty well, that we've got some great insights into the US through our own research and also working with Fisher. And just by being in the market for decades now, sorry Mark and Stephan, that you just get used to different nuances with different sectors. In the commodity sector, management teams are incentivized to spend money. Their bonuses are almost reliant on it. So if a management team within and I'm not saying necessarily Rio and BHP, they're really high quality companies, but we could buy a whole basket of copper producing companies, and those guys are incentivized to find commodity deposits or copper deposits and then get them to production.
Yeah.
And
so to dig holes,
and it costs a lot of money to dig holes. And so while they might go up really aggressively in terms of their share price when they find a mine, they can also go down a lot if they spend too much money in the mine, or if there's not as much deposits as they thought, or the government in the country that they're opening the mine in all of a sudden wants more royalties than they initially said, or whatever the reason. The volatility in those are huge, and having that ability to go, what, we like the theme of electrification, we like the theme of copper, and we want to hold a purist exposure to it, as opposed to getting in the nuance of what management team decisions are trying to do in that particular sector.
Operating risk.
Yeah, exactly. And now you get probably a better return over time if they nail it, but you also can get a much poorer return if they don't, and that would be a key reason why we use futures contracts in these commodities.
Okay, thank you both. It's been really, really useful to understand the broader outlook where you feel we are today. Lots of positive things. Lots of it's exciting for New Zealand to be turning a corner, it feels like, and I'm really impressed that we didn't spend much time talking about the election and what impact that will have, maybe for another call. And it's also really, really helpful to get a sense of how the US economy is going, and I guess that is continuing to grow well, even with all of the the noises you coined it, and all of the factors pulling different directions. The fact that the banks, the big American banks, are saying this is broadly as good as it gets, that's really encouraging. And I look forward to you joining us again in a month or so, Mark, and hearing where we're at then.
Cool. Thank you all.
Thank you for joining us, everyone.
New Zealand Funds Management Limited is the issuer of the NZ Funds Active Income Series, NZ Funds Active Inflation Series and NZ Funds Active Growth Series, together the NZ Funds Active Series, as well as the NZ Funds KiwiSaver Scheme, the NZ Funds Managed Superannuation Service, NZ Funds Wealth Builder and NZ Funds Income Generator. For further information or to request a copy of the product disclosure statement for each of these, please contact NZ Funds or visit nzfunds.co.nz. This recording is provided for information purposes only. The information provided is not intended as a substitute for specific professional advice on investments, financial planning, or any other matter. Past performance is not an indication of future returns.